Welcome to Brainfood Bytes. I am Tiffany Wyszkowski, a project manager at the Financial Accounting Standards Board. We recently published in December of 2023 an accounting standard update to improve the accounting for and disclosure of certain crypto assets. ASU 2023-08 is applicable to all entities, including not-for-profit entities. The amendments in the ASU apply to all crypto assets that meet all of the following 6 criteria. 1, meet the definition of an intangible asset. 2, do not provide asset holders with an enforceable right to or claim on underlying goods, services, or other assets. 3, are created or reside on a distributed ledger based on blockchain technology or similar technology. 4, are secured through cryptography. 5, are fungible. And 6, are not created or issued by the reporting entity or its related party. Based on the scope, this means that the more common types of crypto assets like Bitcoin and Ethereum are in scope. However, this also means that non-fungible tokens, or NFTs as they're commonly referred to, are excluded from the scope of this new guidance as they are not fungible. Now that you know what's in scope, let's talk about how to measure and present these crypto assets in the financial statement. For in-scope crypto assets, an entity is required to measure those assets at fair value each reporting period, with changes in fair value recognized in net income separately from the effects of other intangible assets. On the balance sheet, the crypto assets should be presented separately from other intangible assets not measured at fair value. On the statement of cash flow, you should continue to follow the guidance in ASC 230. However, if crypto assets are received as non-cash consideration or contribution and nearly immediately converted to cash, it should be classified as an operating cash flow. You might be wondering what time period is considered nearly immediately. Well, it means a short period of time that is expected to be within hours or a few days rather than weeks. Also, on the statement of cash flow, if your entity is a non-for-profit that nearly immediately liquidates crypto assets received with donor-imposed restrictions for long-term or capital use, you should classify the cash inflows as financing, which is consistent with the required classification for donated financial assets with those donor-imposed restrictions. Entities will be required to comply with existing disclosure requirements such as those in ASC 820, but also the ASU requires some additional disclosures. Entities will be required to disclose at both interim and annual periods their significant crypto asset holdings and any contractual sales restrictions on in-scope crypto assets. At annual periods, an entity is also required to provide a roll forward of crypto asset activity during the period and the cumulative gross realized gains and cumulative gross realized losses that are associated with crypto assets disposed of during the period. The amendments in the ASU are effective for all entities for fiscal years beginning after December 15, 2024, including interim periods within those fiscal years. That means if your entity has calendar year end, the standard is effective in 2025. However, early adoption is permitted. More information about this accounting standard can be found in ASU 2023-08 on our website at fasb.org. Thank you for listening to Brainfood Bytes.